If you're not buying an S&P 500 index fund and you're picking and choosing your own stocks, you're most likely looking for the best of the best quality companies. And thankfully for you today, I'm going to be going over all of the qualitative measures that make an amazing business to invest in. And the best investment you can make today is hitting that subscribe button for me. So with all that out of the way, let me know your highest quality company in your portfolio right now in the comments section. Now that you've done that, roll the intro.
Hello, I like money.
This video is going over the qualitative measures of business. When it comes to the financials, free cash flow growth, and all that stuff, that's more quantitative, and I've made videos on that in the past. But this is basically going over the strengths of the business itself. I do mention free cash flow and debt in the video, but mainly the strengths of the core business, how it's structured, etc. So here are all the examples that I look for in a qualitative business. I will also be going over examples as well when I go over all these qualities. To start off, we love toll booth companies. These are companies that don't rely on the performance of a particular product. I'm not saying there's anything wrong with companies that don't do this, but we're talking about the best of the best quality companies today. For example, Target may rely on some items that a company like Visa doesn't. Visa's going to have cash flow coming in month after month through their payment processing network that other vendors use. On the Discord link in the description, the other day we were talking about Starbucks and Dunkin' in the rewards program and how basically they use apps. And a thought occurred in my head. What company is really benefiting off of all of this? It's not the consumer, it's not Starbucks, but it's Visa and MasterCard, the companies that are processing and collecting fees off of this. These toll booth businesses are essential to how society operates, and everybody uses them no matter whether you know it or not. Every time you go to a restaurant and you give them your credit card, they have to pay a fee whenever they're using a Visa or MasterCard payment processing network. You don't even know it. You just assume that you're paying the restaurant directly. Toll booth companies are the middlemen in all these business transactions. A few examples of toll booth companies, obviously Visa and MasterCard. S&P Global is too. During slower economic times, toll booth companies have pricing power to make sure that free cash flow consistently grows. Visa actually just announced another fee increase, so even if there's a slower economic time like they're predicting in the next couple of years, Visa is still consistently growing their earnings and free cash flow. As a shareholder, that's the thing that you can't replace. With a company like Target, it averages over time, but that consistency just isn't there. Some months are going to be bad, some months are going to be good. But with Visa, they have the ability in their business structure to make all months good. And yes, these companies are obviously vulnerable to a recession or even a pandemic as we saw a few years ago, but they hold up much better than the others. We also love companies that are naturally monopolistic. A few industries like this are obviously the payment processing industry, data collection, railroad. Whenever you buy a business or a new stock, think to yourself, how much money would it cost for me to compete logically with this company? For example, if you gave me $1 million right now, could I compete with Union Pacific or build a new railway? And obviously $1 million isn't a lot, but it goes the same for basically their market cap. If you were to give me Union Pacific's market cap and tell me to build a bunch of new railroads, I simply couldn't. And same goes with Visa and MasterCard. These are businesses that have established brand reputation and practically impossible circumstances to compete with. Well, ethically, and as an entrepreneur, this is not something that you want to see or agree with. As an investor, it is something that we definitely want to see. We want our businesses to be nearly impossible to compete with and be thriving for the next 50, 60, 70 years. So high barrier to entry and very hard to compete with would count up for that naturally monopolistic feature of companies. Now, a company does not have to be naturally monopolistic for it to be a good investment, but great companies are typically monopolistic. If a company is monopolistic, it opens a gateway to so many other amazing qualitative features you want to see. So those are the big two things. You also want to own businesses that have pricing power. Pricing power is a huge thing, especially we saw in 2022 when inflation went high and Americans are spending lower. That goes for right now as well. An example of this is Starbucks. People are addicted to Starbucks' products, and some would say they can't even live without them. Starbucks, in turn, can raise prices and people will continue to buy their product. That is a sign of an amazing product and an amazing business overall. You want companies and businesses that offer services that are essential or very addictive in people's lives, therefore they can charge as much as reasonably possible. Another two examples of this are Visa and Disney. With Visa, as I mentioned earlier, they increase their fees. Consumers and business rely on Visa's payment processing network to basically do transactions, and Visa can charge however much they want when it comes to the fees side of things. And with Disney, it comes to their parks. Disney's parks are always in demand, and Disney over the last 2 or 3 years, if you've noticed, they've been increasing prices on their parks and basically having the consumer spend more for their experience there. Now, this has been something huge to kind of help keep Disney afloat during the time of streaming unprofitability right now with them. Pricing power is a big thing, but this all is kind of linked back to toll booth companies and being naturally monopolistic. You also want to own businesses that have brand value and brand recognition. Now, I put a star next to this one because there are some companies that this straight up does not matter with. An example of this is UPS. UPS is known to have your packages delivered on time and have had historically better delivery drivers when it comes to consumer sentiment compared to maybe like USPS. You just want to know what you're getting with the business when it comes to a consumer perspective. For example, when I see a McDonald's logo, I already know what I'm going to be getting, and when it comes to companies like that and Starbucks that are globally recognized for their good customer service, consistency, etc., that's something irreplaceable. But overall, you want to see a positive influence when it comes to the brand value and recognition because that will drive back the recurring revenue and free cash flow that will reward you as a shareholder over the long term. You also want to own companies that may or may not have a moat. Now, if you guys don't know what a moat is, we did a video on it on the Cashflow Kings channel. A moat is basically an unfair competitive advantage that's already been built into the company. For example, Disney would have a moat with the brands that they obtain. You can give people a certain amount of money to try to replicate their business, but they simply couldn't due to the brand value and the kind of content that they already own. A moat is a built-in advantage, whether it be through their business structure, brand, or product that they offer, but a moat is often something that's confused. It is very easy to say something has a moat without knowing what a moat actually is. For example, some people might think that Crocs has a moat. You also want to own businesses that are consistently and highly profitable. Some examples of consistently profitable would be like a company like McDonald's. McDonald's business structure in a way that they have recurring revenue for the fees of their franchisees. This basically allows them to act as a real estate company. Watch my McDonald's video if you haven't already. But you want to find companies ideally that have recurring revenue streams that allows their profitability to be consistent. I'm not saying that it's a bad thing to have certain periods and times where profitability is low and profitability is high. Overall, it will average out over time. But this is what separates the okay and good companies from the great companies. The great companies have consistent profitability. Let's take a look at an example. This is Target's profitability. We can see that over time it obviously does average out, but we can see there are up periods and there are down periods. In 2020 and 2021, their profitability was at an all-time high. Then it crashed to a low last year, and now it's trading pretty much in the middle. We can see, though, it's just not as consistent as great companies would typically have it. Now let's take a look at a company like Visa, which has much more consistent and reliable profitability. And guys, I am a Target fanboy myself. I've been known to talk about it on the channel. The thesis with Target is that it's been trading at a poor valuation right now, and it's a good company. Good companies have inconsistent profitability over time, but the hope is that they will average out over time for a really solid return. And this is Visa's profitability. We can see how consistent it has pretty much been ever since 2008 when the Great Recession happened. This is something that ideally you love to see with your great businesses. Their profitability has been great for the last 20 years, and we can see that their profitability has also trended up over time. Now, with profitability, it's not like free cash flow where over time you should just expect it to rapidly grow. So profitability is a huge thing. You also want to see amazing growing free cash flow with the companies, and you want to see pretty much low in debt or them using their debt efficiently to grow the businesses. With debt, it is kind of a tricky thing because you do need to do your research on it. For a company like Target, you might look at their debt and think it's automatically bad, but if you do your research and you see that it's mainly short-term store leases, it's not horrible at the end of the day. And finally, guys, I think to kind of wrap off the video, you need to find businesses that have unfair competitive advantage. That kind of ties back in with the moat. But just find businesses that if you put yourself in the shoes of a competitor of that business, that you would have headaches trying to compete with them. That's the greatest thing that you want to see in a business when you're buying. If you're wondering the tool that I use to analyze all of my company's financials and see if they're really as great businesses as I say they are, I use DividendData.com. For all the cool metrics that the website has, portfolio tracking, stock research tool, valuation models, and more, try out DividendData.com. You could try it for 2 weeks free. The link is in the description. I highly recommend it. It is the ultimate time saver when it comes to researching stocks, and it is a very easy and efficient tool to use. I want to thank DividendData.com for sponsoring the video, and I want to thank you for making it to the end. I greatly appreciate it, and let me know what is your highest quality company in your portfolio right now and why in the comment section. I'd love to hear. Me personally, I would say Microsoft right now. Thank you all for watching, and of course, do dividend stocks, not drugs. Have a good one.